$2 billion quietly slipped out of New York in June 2025, boarding a northbound train with no return ticket. Behind a closed suite in downtown Toronto, there were no Goldman briefcases, no JP Morgan lapel pins, just the muted click of Barclays laptops and a dossier stamped Ontario Sovereign Bond, $2 billion. It felt less like finance, more like protest, etched in ink and basis points. Bay Street grinned. If Washington taxes our steel, we'll tax its pride. Because when allies start funding their futures without America, the balance sheets begin to look like ballots. Ballots cast against the man in the White House. February 2025 slammed shut like a steel door. Washington hit Canada with double-digit tariffs on steel, auto parts, circuit boards, and raised them again on China. By April, supply chains groaned, currencies wobbled, but Ottawa didn't shout. No hashtags, no retaliation, just one surgical strike at America's soft spot, capital. If you tax our factories, one Canadian official whispered, we'll reroute your money. And that's exactly what happened. On June 9th, Ontario entered the market with a 10-year $2 billion US dollar bond, and pointedly excluded every American bank. Barclays steered the deal, flanked by homegrown titans, CIBC, Capital Markets, Scotiabank. It was the first time since 2011 that a major greenback issue from Canada's largest province shut out Wall Street completely. Bloomberg's Chunzi Shu called it a watershed. It wasn't bookrunner rotation, it was retaliation. Ontario didn't just sell a bond, it flipped the script. If the White House taxes production, Ontario will tax prestige. By choosing Barclays over Goldman and sidelining JP Morgan and Bank of America, Ontario raised $2 billion. And raised a flag. A message to Washington: we can raise dollars without you. Wall Street felt the sting. U.S. banks had long dominated Canada's dollar issuance, pocketing fees and shaping norms. Now they're watching from the glass, sidelined. We've moved from first call to afterthought, one syndicate manager admitted off record. Ontario's financing authority expects up to 30% of its projected $60 billion borrowing to now route through non-U.S. channels. Capital that once padded Manhattan ledgers is finding new ports. Beyond the fees, it's about influence. If provinces benchmark to the ECB curve instead of the Fed, they decouple more than interest rates. They dilute political gravity. Canada hasn't declared financial independence. It just quietly erased the United States from the footer, one bond at a time. If Ontario's move was a snub, Alberta's felt like a storm front rolling through lower Manhattan. On March 26, Alberta, oil-rich and always blunt, tapped the euro market for 1.25 billion euros, about $1.35 billion USD. Barclays, RBC, and TD led the charge. No Bank of America, no Wall Street. Premier Danielle Smith called it energy insurance. Alberta could still send oil to the US, but now it has options. Asia to the west, Gulf of Mexico to the south, Brussels, not Broadway, and crucially, priced in euros, benchmarked to ECB yields, not the Fed. In Frankfurt, desks are now quoting Alberta CDS spreads. Treasury officials are modeling swaps that never touch a US line. One trader said it best, if you clear billions in euros, you start dreaming in euros. Every bond, every swap is a shift in orbit, and it's not just Alberta. By April 2025, the IMF flagged dollar stress in Canada not seen since the late 90s Asian crisis. In Vancouver, swap spreads blew out by 42 basis points in a week. Smaller lenders scrambled. The Bank of Canada issued a rare warning. If the tariff war drags on, we could face a liquidity crunch. And just like that, the escape hatch opened east. RBC began quoting 5- and 10-year corporate hedges off the Euribor OIS curve. ECB guidance, not the Fed, began setting the marginal cost of funding. Swap desks in Europe were blunt. We price Canada off Lagarde, not Powell. ECB swap volumes with Canada hit a 2-year high in June. The mechanics are subtle, but seismic. Canada still has a Fed swap line, but it increasingly taps the ECBs, converting euros into dollars only when terms favor them. Each trade pushes Canada's risk-free rate a hair closer to Frankfurt. The question isn't can Canada live without the Fed, but when will bond markets stop caring what the FOMC says? Ontario's capital routing is already reshaping blueprints. The province projects nearly $60 billion CAD in borrowing this fiscal year, with 30% from foreign markets. That means billions in subsidies for Ford, GM, Honda, priced in Frankfurt, not New York. And that comes with terms. European lenders bring a different calculator. RBC's 2025 Sustainable Finance Outlook reports 2/3 of EU asset owners apply ESG screens to more than half their portfolios. The rule is simple. Clean factories get cheap loans, hybrid drivetrains are out, fully electric or hydrogen-powered, in. In May, Honda froze a $15 billion USD EV complex in Alliston, citing trade turmoil and funding uncertainty. With no Wall Street fees and no Washington tax credits, Honda must now court European green bond buyers, who demand stricter carbon metrics than anything in the U.S. Inflation Reduction Act. Ford and GM face a starker choice: retool for zero-tailpipe models, or watch Chinese EVs fill the void. One Detroit exec put it bluntly: "Your cost of capital is now set by someone reading an ESG dashboard in Paris, not a risk model in Charlotte." The real shift came with one speech. April 24, 2025, Premier Doug Ford on stage at the Canada Growth Summit declared, "Donald Trump is trying to wipe out our auto sector and take over Canada. We're finished playing by his rules." 10 days earlier, Finance Minister Bethlen Falvey had called Trump's tariffs a wake-up call, a demand for sovereign tools beyond Wall Street. Together, those statements redefined Ontario's bond deal and Alberta's euro debut, not as strategy, but as sovereign resistance. Traders caught the signal. Within 48 hours of Ford's remarks, Ontario's 10-year Yankee bonds widened 7 basis points versus U.S. Treasuries. Minor in retail terms, massive in algorithmic trading, where spreads shift on tone. Dealers joked, the new risk-free rate north of the lakes depends on Queen's Park pressers. More importantly, Ford's words gave CEOs air cover to pivot. When a premier declares financial independence, a CEO can cite strategic alignment to chase Frankfurt's green money, or route lithium deals through Jakarta. That moral license, not the 7-point spread, is what really shook Washington. And while Wall Street sulks, two rivals are already auditioning to bankroll Canada's next chapter. Europe looks like the air. Ontario's January green bond deck lifted EU taxonomy language verbatim. Frankfurt and Paris desks snapped up $1.25 billion CAD in minutes. Behind the orders, the European Investment Bank, flush with a record 95 billion euros lending mandate. Brussels is sweetening the pot. A 3 billion euros battery value chain program with ultra-cheap loans for cathode plants. But only if they hit circular economy targets. And China, still in the game. Despite Ottawa's security filters, Chinese firms quietly secured new critical mineral assets in Canada late last year. Globally, Chinese miners just logged their busiest acquisition season since 2013, hoovering up lithium, cobalt, rare earths. They're angling to control the inputs Europe needs for its green transition. The fight is no longer about who underwrites the bond, but who writes the rules. Europe offers low coupons with ESG strings, no hybrids, carbon audits, traceable sourcing. China offers metals, machines, breakneck speed, and strategic ambiguity. For Queen's Park and Edmonton, it's a messy choice. Align with Europe and inherit slow growth, or dance with Beijing and risk swapping one dependency for another. But this much is clear. Every euro raised, every lithium shipment secured, shrinks the space Washington once ruled, and no tariff can reclaim it. North America's balance sheet is being redrawn. If Brussels keeps supplying green capital, Canada could fall into Europe's regulatory orbit. If Beijing wins the supply chain, Chinese leverage will reach far beyond minerals. And if Washington escalates, the battlefield shifts. From tariffs to software, semiconductors, and the digital bloodstream of modern power. Because once capital deserts New York, can the White House still command the assembly lines of Ontario?